Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about a topic that I think is very important given the excess market volatility that we've seen over the past few weeks, but more importantly, also the past few months, and how you can potentially protect your portfolio if we see some more volatility going forward and some further downside here in terms of equities. Now, before I start, I just want to ask everyone here on the session a simple question. If you can bring up your chat window, which is at the bottom of your screen, and please type yes into the chat window if you are concerned that equity markets could pull back further from where we currently are. And please type no if you are not concerned and you think equity markets will simply continue on its upward bullish trajectory. Okay, so I see a lot of yeses. I see so far a couple of no's, a few no's now. But certainly, I think more yeses now than I have seen historically when I do these sessions. Now, doing the session today is not by any means a suggestion that I think markets are going to correct. It's simply the fact that trying to protect your portfolio using options during a market correction is something that requires practice to understand how to go about doing so, making sure you understand what options are available to you, so that if and when the markets start to correct, you have the skills, you have the knowledge to know how to do this. It's something, it's like understanding how to do something before you need it. So today's session is designed to make sure that you understand, if you believe that markets are going to correct, what strategies can you deploy for your portfolio to allow you to implement strategies to protect your portfolio. Now, before we get started, what we are going to discuss here is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities that we are going to discuss here today. Now, we'll start off by taking a look at the broader market outlook to see where the markets are currently trading and give you an understanding as kind of my thoughts around this. You'd currently have talking through the different strategies that you can deploy in a recession. And then we'll talk a little bit about the portfolio hedge strategy. You have quite a few different strategies that you have, so we'll want to talk about this so that you understand what options you have. And then the stages of a market correction, talking specifically regarding when should you think about putting on a hedge, when should you think about taking off a hedge. Timing of that stuff is extremely important. And talking a little bit about optimal portfolio hedges, and then we'll open this up for Q&A with some live examples here at the very end. But the primary thing that I want to help you understand is how can you efficiently hedge your portfolio against a major market correction using options. That's what we want to discuss here today. So let's start off by just taking a look at the broader market outlook. If you look at the OMX S30, on the left-hand side, what I have is the weekly chart of the OMX S30. So what you see here from the weekly chart here is that we have largely made very little progress since March of last year. So the OMX S30 reached the 2230 level here in roughly March of last year. Now, while it did trade as high as about 2400, it largely has been range bound since then. It did make one attempt to break out higher from this trading range. Let's just call it a 2200, 2400 trading range. It did make one attempt to break out higher here towards the end of last year, beginning of this year, but that has failed, and the market has continued to trade range bound since this has started to happen. So right now, I wouldn't call this market overly bearish. What it is just very neutral. It hasn't moved from this trading range, but we have made multiple attempts to test the bottom end of this range over the past few months, and especially multiple attempts here over the past few weeks. On the left-hand side here, what you see is the daily chart. This 2200 level has been tested multiple times. Now, this level has held each time it has been tested. But one thing I will point out here, if you zoom in onto the daily chart, is that each time we test the 2200, each time we bounce a little bit less, meaning lower highs. This leads me to believe that there is potential that this revisits 2200 and can potentially break lower. But we have not seen that test yet. We have not seen the breakout below 2200. And for those reasons, that's why I don't think the markets right now are bearish. But again, the session here is not to tell you that markets are bearish and you need to hedge. The session here is to tell you, if you do see the market start to break below 2200, what should you be doing in your portfolio to potentially protect your portfolio? So this is really what we want to discuss, are a few different options, because you have a lot of options when it comes to protecting your portfolio. It's not just using options. Options is complicated, it's expensive. So I want to explain what your other options are before you look at using options in your portfolio. So first, there's a thing, what we call a perfect hedge. This is where we're effectively taking assets that you own in your portfolio and moving them into cash. And what you want to do is you basically want to reinvest after the correction. So if you think markets are going to crash, sell some of the stocks you own, sell some of the risk assets that you own, and simply buy back with that cash once you feel that the correction is over. And this is what we call a perfect hedge, because it hedges your position perfectly, right? You don't lose any money if the assets are parked in cash versus in the broader markets. Now, that may not be suitable for everyone, so you might want to remain invested. You may not want to move into cash. So you can also reallocate your assets to more defensive assets. You can look at fixed income markets. You can look at bond markets. You can simply look at more defensive sectors. Right now, looking at even energy or banking, those are some of the places or sectors, if you will, where you are getting some better protection, especially sectors where you are getting some dividends that will offset some of the downside losses that you may have in the equity markets right now, or potentially gold. So those are more defensive assets, or traditionally what we consider more defensive assets that you may reallocate in during times of market volatility. And if none of those strategies make sense to you, if you don't want to reallocate, you don't want to move into cash, and you want to remain invested in the holdings that you own, that's when you might want to explore a portfolio hedge. This is when you're buying a put option to protect your portfolio. This generally is something that you want to do when you expect that the markets are going to correct by greater than 5%. And you simply own these stocks or ETFs, and you do not wish to sell any of your holdings. But you should only think about this if you decide that moving into cash is not suitable for you, and reallocating to more defensive assets is not suitable for you. Does that make sense? Please type 1 into the chat window if that makes sense. This is only something you should consider if moving into cash and moving to more defensive assets is something that you decide is not suitable for you. Perfect. Okay. So what is a portfolio hedge? The best way to think about a portfolio hedge, even though it's not exactly the same analogy, but similar to it, is think of it as buying an insurance policy for your portfolio during a correction. And you're buying an insurance policy on your portfolio by buying a put option on a broad-based index, so either an ETF or an index option on the market that you own an asset in. Now, the profits from the puts that you purchase will offset the portfolio losses that you have in your portfolio. So just to be clear, this doesn't protect your portfolio from losing. You just have a separate asset that you own that will rise in value as the markets fall. So that kind of offsets some of the losses that you have. And it's important to understand that this creates an imperfect partial hedge, meaning it's never going to protect your portfolio fully. you might have some, you might have, 100,000 crown loss in your portfolio, and then you might make 40, 50, 60,000 crowns back from the put option. So you're not making the full $100,000 loss back from your portfolio. But the most important thing to understand, and this is the one thing that if you learn nothing else from today's session, the most important thing to learn is that buying portfolio hedge is extremely expensive. A lot of people think about insurance policies. You just buy them all the time to protect yourself. Think about your car, your home. You always have car insurance. You always have home insurance. Well, you can't always have portfolio insurance, because if you did, your portfolio would severely underperform, because portfolio insurance is extremely expensive. So it requires active management and requires timing of the markets. And this is really the trickiest part about portfolio hedging, is that conceptually it's easy to understand, or it's not difficult to understand, but extremely difficult to implement because of how expensive it is. Does that make sense? Please type 2 into the chat window if that makes sense to you. So let's talk, perfect. So let's talk about what is a portfolio hedge. So this is your portfolio. Your portfolio consists of equities that, as the markets rise, the value of your portfolio rises. As equity markets fall, the value of your portfolio falls. It's generally speaking, a symmetric risk profile that you have with your equity portfolio. What we're adding to it is a put option. A put option increases in value as the markets decline, but also has capped losses, meaning there's a limit as to how much money you will lose on that put option if the market does not fall, or if the market rises in turn. So you have unlimited potential profits as the markets continues to fall, with limited losses when the markets rise. So if you combine these two strategies, your portfolio plus a put option, you get a payoff graph that looks something like this, where you still maintain upside exposure. So if you buy a put option and the markets continue to rise, it doesn't limit your profits. You can, because you pay a set amount for the put option, or you pay a set amount for the insurance policy. And if the market's rising, you never need it, that all you lose is the premium that you pay for the insurance policy. But if the markets continue to decline, you will have losses in your portfolio that will be offset by gains in the put option. And just to make this a little bit more clear, the real portfolio would look something more like this, meaning you're still going to have some losses in your portfolio, but it's going to be less than if you didn't buy a hedge on your portfolio. Okay, so let's talk a little bit about these types of strategies. So you can think about the type of correction that you're concerned about. Now, as you can see, when you look at the equity markets, we have somewhat frequent small pullbacks in the equity markets, somewhere in the 3 to 5% range. Many times these are, especially these days, these types of pullbacks happen very, very quickly, sometimes over the period of just a few days, sometimes a few weeks, but they happen quite often. And sometimes there's a lot of extreme volatility around it, and investors many times get concerned. We see some investors sell some of their equity holdings during these types of extreme volatility events. So, and then at the same time, you can also be concerned about a larger pullback. Now, these don't happen very often, but when we are concerned about a pullback greater than 5 to 10%, there's different kind of strategies that you want to deploy. So short, kind of buy the dip pullbacks. This is really when you want to use shorter dated options, usually 1 to 2 weeks, options that expire in a short amount of time, because this will help you maximize gamma, so that you can get that leverage factor on the put options that you purchase. And then if you do think the markets are going to correct significantly, that's when you want to use a longer dated option, usually options that are greater than 2 months or greater. So when I was showing you that OMX S30 chart, when the markets are kind of range bound and you're concerned about a pullback towards the bottom of the range, that's the type of strategy when you want to use options that are maybe 1 to 2 weeks from expiry. But when the market maybe breaks a major support level, that 2200 level, if it breaks that level and you think the markets could correct another 10%, 20% from there, that's when you want to use potentially longer dated options, maybe greater than roughly 2 to 3 months or so. Does that make sense? Please type 3 into the chat window if that makes sense to you. So, you have kind of normal market kind of volatility, and then you have, hey, I think this is really different from what we've seen in the past few months. This looks like it's getting pretty serious. I'm seeing risk across the board. I think I need to hedge my portfolio. There's a difference in terms of how you go about selecting which expiration dates you use for these types of strategies. And then when we talk about selecting strike prices, this is really thinking about coverage, right? And the way that you can think about expiration dates and strike prices is think about the insurance policy. Think about buying an insurance policy on your home or your car. You have choices, right? You have choices as to how much coverage you want. You may even have choices as to how long you want coverage for. So if you think of a small pullback, that's like going traveling for a couple of weeks and you need health insurance to cover you while that travel versus you need health insurance overall for the next year because you're living in the country that you live. So you can select how long you want an insurance policy to last for, and then you can also select strike prices, which is how much coverage do you want. So just like when you buy insurance for your car or your home, you can choose to have catastrophic insurance, which means that it only pays out if there's a large loss. Or you can buy more comprehensive insurance that basically pays out regardless of any loss. It'll give you coverage. So it really gives you a lot of options in terms of what you can do. And strike prices really give you the ability to customize and decide how much coverage do you want. And obviously with insurance, the more comprehensive insurance is going to be more expensive. Now, the great thing is that you have this full spectrum of strike prices that allow you to select different variations of coverage that you want. And you can also even have what we call limited protection. This is really where you have a certain amount of downside correction. And this is really kind of where you get into the benefits of options, right? Because you can buy major catastrophic insurance. This is when you're buying out of the money put options. This is what we call about a 30 to 40 delta. And I'll show you what that means on options play. You can buy comprehensive insurance, which will protect you against any downside correction. This is when you're buying in the money options. These are going to be more expensive. Or when you're buying a certain amount of downside correction, what you're doing is you're doing both. You're kind of buying some options. You're buying an in the money option. And then what you're doing is you're selling an out of the money option. So not only are you buying insurance, you're also at the same time selling some insurance to someone else. And what that does is it reduces the cost of your insurance policy and it gives you limited protection. And we'll talk a little bit about the pros and cons of each one. But you have a lot of choices. It's really kind of what this hopefully illustrates. And I'll go through some real examples to help you understand each one. But does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's look at some options first, and then what we'll do is we'll come back to talk a little bit about timing, because I think at this point what we've done is we've talked a lot about different options, and I think it's best to actually look at some real examples. So I'm going to use the OMX S30, and I'm going to reset everything so that I can show you kind of how to go about doing so using options play. So when you type in an index, and right now I'm using the OMX S30 as my index because most of you here are probably familiar with this index. Most of you have portfolios that are similar to this index, meaning when the OMX 30 is down 5% over a month, your portfolio's I'm guessing will roughly be down close to about 5% or so. Now, if let's say you live in a different country and you're predominantly using Danish indices, then you can maybe use, or you predominantly own Danish stocks, you might want to use the Copenhagen 25 index, or you can use the Oslo index or the Helsinki index, depending on where you live and what your equity portfolio consists of. But for now, for this purpose, I'm going to use the OMX S30 index, which is currently trading at around 2263 as of today's close. And what we're going to do is we're going to use this index as our proxy for your portfolio. And what I want to show you is buying some put options on the index and showing you how it protects your portfolio and showing you how much you lose in your portfolio and how much you gain back on the protection. So what I'm going to do is I'm going to flip this and I'm going to look at buying one contract of the Stockholm S30 index future, which is currently trading, which has a market value of about 228,000 crowns for a single contract. And then what I'm going to look at is buying a put option. And I'm going to look at buying a few different put options just to illustrate to you the difference between the two. Okay, so I'm going to use an out of the money put option, and I'm going to use an in the money put option and show you the difference between the two. And before I use these two examples, what I'm going to first use is the risk and investment calculator, which is the third dot here from the bottom of your screen. And the risk and investment calculator allows you to actually simulate a specific portfolio. So for example, if I have, let's say, a 1 million crown portfolio, let's say my portfolio is roughly 1 million crowns, then what I can do is I can calculate the number of contracts that I need to purchase of the put options in order to actually protect my portfolio. So this portfolio will mimic my 1 million crown portfolio, buying 4 contracts of the April 2350 puts. 2350 is an in the money option because it is higher than the current price of the OMX S30. And then what I'm going to look at is also buying at the same time an April 2240 put. That's an out of the money put option. Maybe I can go a little further out of the money just to illustrate kind of the difference between the two. So as you can see here, on a 1 million crown portfolio, my in the money or my comprehensive insurance will cost me 49,000 crowns, just about 50,000 crowns, about 5% of my total portfolio value. My catastrophic insurance only costs half as much, about 25,000 crowns. So about 2.5% of my $1 million portfolio. And what I want to show you is I want to show you these two options side by side. I want to show you how they perform side by side so that you can see as my portfolio declines in value, how do these two strategies provide protection? So we'll start off by presuming that the markets don't move. The market stays exactly where it is, around 2280 or so, which is actually where the markets closed here today. So let's say the markets don't move. Let's say you go out 2 months from today on April 13th when this option expires, and the markets do exactly what it's been doing over the past few months. Let's say it goes a little bit higher, goes a little bit lower, and then a few months later, it ends up at exactly 2230 or so, 2280 or so, around this level. If that happens, well, the portfolio will see no losses, right? So you won't have any losses in your portfolio, but what you will have is some losses on the insurance policy because you've paid premium on the insurance. If you don't need it, you lose the premium that you pay. And this is really where the catastrophic and comprehensive insurance will differ, because the catastrophic insurance, as you can see, you've lost the full value, the 24,560 crowns. You pay for the catastrophic insurance. If you don't need it, you lose 100% of it. The comprehensive insurance, you lose $49,000. You pay $49,000 in premium. But as you can see here, you've only lost 22,400 crowns. And this is because when you're buying comprehensive insurance, not all of it is extrinsic value. Some of it has intrinsic value. So even if it doesn't move substantially lower, you will actually not lose the full value of the option. Does that make sense, everyone? So even though you've paid more in premium, because of the comprehensive insurance, not all of it is extrinsic value, you will be able to see gains. You won't see the full losses on the strategy if the markets don't move lower. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so if you now let's take a look at what happens if the market starts to move a little bit lower. Let's say the markets move down to this 2200 level that we're talking about. So it doesn't correct potentially, but it gets back down to that major support level here. So that is about a 3%, 3.5% decline in the portfolio. What you see here is that now you've lost 3,500 crowns in the portfolio. Now, this is, as you can see, the comprehensive insurance already starts to kick in. This is what you get with comprehensive insurance, is that even the market corrects a little bit, 3.5%, you get some protection back. So you lose 35,000 crowns in your portfolio, you gain 10,000 crowns back. But as you can see with the catastrophic insurance, not only do you not gain anything back, you actually still have losses from the premium that you've paid. So you've paid 25,000 crowns in premium, but you've made back, or you still lose an additional $16,000 of that premium that you pay with the catastrophic insurance. So the catastrophic insurance, in a 3.5% decline in the markets, you don't see any actual protection. Does that make sense? That you don't see protection with the catastrophic insurance unless the markets correct further in this particular case? Whoops. Please type 2 into the chat window if that makes sense to you. Sorry, I'm having a little bit of a technical difficulty here. I apologize. So as you can see, the comprehensive insurance will start to cover your losses even for a small loss, but a catastrophic insurance will still have losses unless the markets correct further. And this is really where we start to look at, well, what happens if the markets break below this major 2200 level? Let's say it gets down to 2100, okay? So now you've lost about almost 8% of your portfolio, about 80,000 crowns. Well, you're going to make 50,000 crowns back from your comprehensive insurance. So you lose 80,000, but you make 50,000 crowns back from your comprehensive insurance. Your catastrophic insurance at this point will start to kick in, right? So you've had a fairly severe, it's not a major market correction, but certainly a sizable market correction, about 8%. Well, now the catastrophic insurance will start to kick in. So you've lost 80,000 crowns in your portfolio, but you make about 24,000 crowns back in addition to that. So the catastrophic insurance starts to kick in at this point, but as you can see, it's covering a relatively small percentage of the losses that you actually have in your portfolio, versus the comprehensive insurance covers a fairly significant chunk of the portfolio. It doesn't cover everything, but it covers a significant chunk of your portfolio. And this is really where you can use the P&L simulator of options play and see how much does the protection actually provide you versus the portfolio that you actually own in your portfolio. And using the P&L simulator, you can type in, you can choose different options for your portfolio. You could choose different expiration dates. You can choose different strike prices. And this is really something that you have access to. You can customize the different options that you have and see how much protection that you would actually get depending on which options, which coverage that you select. So think of it as like a model for the insurance policy that you purchased, right? You can see, well, if this is the losses that I have, how much protection do I get? Using options play gives you the power to test and understand the different coverage options that you have, how much it costs, and how much protection you actually get from it. So what I'm going to do now is I want to show you also at the same time a put spread. So you can also buy a put spread. And what a put spread does is it allows you to effectively buy an option. In this particular case, what I'm going to do is, as you can see, a comprehensive insurance. I'm going to go back to the previous one, the 2350 one. And what I'm going to do is I'm going to buy a 2350 put option, but I'm going to sell, let's say, a 2150 put against it. So the best way to think about this is think about buying an option. Think about buying an option, a 2350 insurance policy, but at the same time selling a 2110 policy against it. So not only are you going to be paying premium, but you're going to be selling some premium or collecting some premium. And that's going to offset the cost of the hedge. And what you're going to be able to do is see, if you traded 4 contracts of each one of these, how much you would actually gain from this particular strategy. And this is really useful because if you're using this, you can actually see the difference between the comprehensive insurance versus a limited insurance policy, because it's going to show you the difference in terms of price and then show you how much protection you're actually able to receive out of this. So as you can see here, you have about a $9,000, 9,000 crown protection versus a 49,000 crown protection. Give me 1 second. Let me just reset this. I think what's happening here is that I was logged out. I'm going to log back in. 1 second. Okay, here, let me get back to 2350. We're going to compare these two strategies side by side. Okay, so, whoops, this is 4 contracts, and this is 339. Or you know what? We're going to go back and we're going to do $1 million portfolio. We're going to calculate. Okay, so sorry about that. What I'm comparing here is still $1 million portfolio. What I'm buying is the comprehensive insurance, which costs about 56,000 crowns, versus buying the comprehensive insurance and at the same time selling some lower insurance against it. Meaning what I'm saying is that I think the markets are going to correct, but I think there's a limit as to how much further the markets can correct. And what you become is not only a buyer of insurance. Here, what I'm buying is the April 2350 puts, but I'm also going to sell the April 2090 puts against it. And here, I'm going to pay 139 crowns in premium for the 2350 comprehensive insurance. And then what I'm going to do is I'm going to be a seller of the catastrophic insurance at the strike price of 2090 for 35 crowns. And what this does is it lowers the premium that I pay. It lowers my premium from 56,000 to 41,000 crowns. And what it does is it gives me protection, but it limits the amount of protection that I get. So let's take a look at how this performs. So let's say the market starts to move a little bit lower. Let's say the market moves down to that 2200 level that we were talking about, 2200. Whoops, 2200. There we go. That's about a 3% correction in the markets. I'm losing 27,000 crowns on my portfolio. As you can see, my comprehensive insurance, the one that we were talking about before, it does provide some protection, but not a whole lot because the markets hasn't corrected much. Even the comprehensive insurance doesn't really kick in much. I've lost 27,000 crowns. I made 3,400 crowns back. But as you can see, if I look at my catastrophic, my limited insurance policy, the custom one that I've created, I'm making 18,000 crowns back. This is really kind of the benefit that you sometimes get with these types of insurance policies, because not only are you a buyer, you're also a seller of catastrophic insurance, where you sold the insurance policy, but you didn't have to pay anything out. So you get the premium from that in addition to what the comprehensive insurance is paying out. So you're getting much better coverage here in the short run, in the small correction that you're seeing here in the broader markets. And you're going to see that that's true until you have to pay out the catastrophic insurance. So the lower strike price of this catastrophic insurance is 2,090. So if the markets decline below 2090, now what you paid in insurance policy, what you get out of the comprehensive insurance, you're going to now give back to someone else because you've sold the catastrophic insurance policy. So you get really good coverage down to that 2290 level, as you can see here, down to 2090 level. You lose $76,000 in your equity portfolio. You make almost all of it back, 62,000 crowns back. So up to this point, you get really good coverage. But if the market starts to go lower, even further than that, now you are no longer covered anymore. You are capped in terms of the amount of coverage that you get at 62,000 crowns. So that is the third option that you have when you're thinking about buying insurance. These are the three options that we discussed here today. These three options, where one is major catastrophic, which only pays out in a major correction, comprehensive, which pays out in any downside correction. Those are the most expensive. Or you can buy limited protection, where you are not only buyer of protection, you're also a seller of protection. You're basically buying comprehensive insurance and then you're selling catastrophic insurance to someone else and taking the premium that you get from that to help pay for the insurance policy here. But that only gives you limited downside protection down to a certain level. Does that make sense? The three different levels of protection that you get from this? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so this hopefully illustrates to you the different options that you have, and showing you how you can use options play and test out the different options that you have and see how they perform. But the one thing I want to talk about is really timing, and this is really the trickiest part about trading, or buying protection, is when do you think about pulling out your hedge. So these options that I'm showing you here, you can hold them to expiration, but I don't recommend holding them to expiration. What you do want to understand is how markets perform, how markets behave near market bottoms, meaning you're never going to be able to time exactly the top to buy insurance. Usually you kind of wait for the markets to break below some key levels. The 2200 right now in OMX S30 is one of those key levels. You kind of wait for those breakdowns. Sometimes you miss that initial move. You wait for a bit of a pullback here, and then maybe you enter that hedge on the pullback. But the question is, how long do you hold on to that hedge for? If you get into the hedge and the market's bottom, sometimes you get out before the actual market bottom. Sometimes you get out way after the market bottom. So I want to talk a little bit about how markets tend to behave near a bottom. And I'm going to use the S&P 500 and the VIX as a proxy for this, but you can see this in many other, you can use the OMX S30, you can use a few different indicators here, but the behavior is the same. It's when we start to see volatility indicators or momentum indicators move in the opposite direction of the market. So usually when you look at momentum indicators, usually when you look at volatility indicators, you see that they are either inverted or they work along with the market. So volatility indices work as an inverted measure, right? So as markets move down, as you can see in the candlesticks, the volatility index moves higher. They're inverted metrics. But what we tend to see is that near a market bottom, what you will get is that you will typically see multiple days where the market continues to decline, but at the same time, the metric that's supposed to be inverted from the market no longer sees that same relationship. So as you can see, this is the 2020 sell-off during the initial phases of COVID. If most of you remember that, that was a pretty violent month, if you will, in the equity markets. Markets sold off here about 33%. And towards the end, towards the last 5 days of the sell-off, what you saw here is that the markets continue to move lower, but volatility, VIX, no longer move lower. Volatility actually moved lower along with the markets. So it loses the relationship, the inverse relationship that volatility has to the markets. When you see this, this is usually a pretty good sign that the markets are near a bottom. Now, if you don't have a volatility index and you only have, let's say, a momentum index, right? And we can take a look at the OMX S30 as well during this sell-off here. If you only have a momentum index, what you will see also during that time is that, and I will add some studies here. Let's add something like an RSI. I don't know if I have enough data here, but what you will typically see here is that near the market bottom, before the market actually bottoms here on March 16th, or even if you consider March 23rd the bottom, is that even though the markets were moving lower during those few days, momentum was actually starting to move higher. So momentum typically moves with the market. So as you can see, as the market moves lower, momentum moves lower. But towards the market bottom, towards that exhaustion period, what you start to see is multiple days where the market continues to move lower, but momentum is actually moving in the opposite direction. That is usually a good sign that you are near a market bottom. If you observe that, that is usually a time where it's time to get out of the markets or get out of your hedge. Now, we haven't seen any type of pullbacks like that recently. We just haven't had any violent pullbacks here. So this is something that we haven't seen. But when you get those violent pullbacks, many times the market bottom is you will typically see with that market bottom is some capitulation or exhaustion. And that usually is a sign where indicators that usually move with the market starts to move in the opposite direction of the market. And when you start to see a few days back to back of that type of price action, that is usually a good sign that even if you still have 2 months left on your hedge, you might want to consider closing out your hedge, because again, of how expensive hedging is, it's important that you only stay in the hedge for as long as you need. You don't want to continue holding on to an insurance policy or paying for a premium on the insurance policy when you don't need it. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so talking about some of the best practices and tips, it's important to understand that even though you can buy insurance on your portfolio all the time, it is so expensive, it is not cost efficient to do so. It's one of the few times where I suggest it's better to be late than early. The analogy is effectively don't buy insurance until your house is on fire. Now, the problem is that when your house is on fire, insurance is going to be very expensive, but you know you're going to need it. Otherwise, you're just buying insurance hoping that you're going to need it. And most of the time, 9 out of 10 times, you're not going to actually end up needing it. So you're basically wasting premium that you're paying for insurance policy that you don't need. So wait until you're sure that the markets are bearish, then you want to consider buying an insurance on it. There's a few different ways that you can offset the cost of the premium. You can sell cover calls on your stock portfolio. You can sell credit spreads on the markets when you're no longer bullish on the markets. You know, over the past year or so, I would consider the equity markets haven't been very bullish, especially if you are owning Swedish equities. So as long as you're not bullish on the markets anymore, start selling cover calls, start selling credit spreads. The premium that you collect from those strategies can be used to purchase the put options if and when you need it. You can also think about selling some insurance, such as with the spread trades. And just remember, if you're looking for better overall protection, you want to buy in the money puts. If you're looking more catastrophic insurance, buy out of the money puts. Those are the ways that you can potentially protect your portfolio. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of buying overall protection on your portfolio, the different choices that you have, and how you can use options play to test out the different choices and play around with them and see just exactly how much protection you get from each one that you purchase. And you can learn more about this if you are interested in the beginner, intermediate, or advanced courses that we have here on options, which is available to everyone free of charge at trade.optionsplay.com/Nordic edu. And if you don't currently have access to Options Play, the tool that I just showed you how to access everything, you can access it at optionsplay.se. I'm going to provide both links into the chat window. If you want to check out more education on the options as a whole, I have other courses on directional strategies, risk management, strike selection. These are all important concepts to understand further if this, what we discussed here today is relatively new to you. And then also understanding how volatility and Greeks factor into this in the more advanced courses. And all of this is available to you within Options Play if you sign up at optionsplay.se. All of these tools are free of charge, courtesy of the NASDAQ exchange. So please take advantage of these resources that are available to all Nordic investors completely free of charge at optionsplay.se. So at this point, what I'll do is I'll open this up for a Q&A. If anyone has any questions, you can type your questions either into the chat window or the Q&A window, and I'll try to answer as many questions as I have time for here today before I have to sign off. And I know there was a question during my session asking if this session is recorded, and the answer is yes, this is recorded along with the slides. We will send that to you as soon as we finish processing those things later tonight. Karen, you're very welcome. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this evening. Again, I hope that this was helpful. Like I said, I hope that you never have to use this, but if and when you do, hopefully now you are better prepared and you know how to go about pulling up Options Play, quickly looking at your options and potentially executing the trade within 10, 15 minutes of doing your research and not having to learn how to hedge your portfolio when the markets are, showing an extreme amount of stress. When you see those big losses in your portfolio, you don't want to be figuring things on the fly at that point. You want to know these things ahead of time and be prepared, and that's what these sessions are for. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here on the next session. Thank you so much, and have a good night.